Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome aboard. You are listening to Money on Tap. My name is Seth Cressman. I'm here with the one, the only Ben Brayshaw. How you doing today?
I'm doing good. I'm with the one and only Seth Cressman. Dan's out again this week. Hopefully he'll be back with us next week. Looking forward to that. He's much better company, Seth. I don't know. Doing these shows with you over and over again, it's killing me. Crickets. Oh, I love you, Seth. Hey, I'm excited about the show this week. I think this is the conversation that we have constantly with what people think is going on in the market and what people are fearing in the market. I think that's a big issue is, what are we going to do if this happens or that happens? And what happens if the market doesn't do anything for the next 3, 4, 5, 6, 8, 10 years? What if we're at the same level 10 years from now? How do I make money?
Is an interesting idea because how often do we have that thrown into the equation? There's the challenge of up and missing that, and then there's the real challenge, especially if you are in your retirement, of a market going down. But just as significant can be a sideways market, and voila, there you have it. Today's topic we are bringing to you are strategies for sideways markets. It's a real deal, people. It happens. It's happened before, and it will happen again. But it's not the topic that you have out there for most people that are approaching this concept of financial planning and how to navigate through all of these questions that you have. But it's one that, guess what? It's important, and we're happy to bring it for you today.
Yeah, I think, Seth, one thing about a sideways market and, the sequence of returns, risk that people face. And if you don't know what I'm talking about, you can go to our website at BrayshawFinancial.com and go to resources, and you can watch a quick video on sequence of returns and look at how the market can really impact your retirement in a way that just a couple years apart between two people investing the same way could be catastrophic or, climbing the mountaintop of success. So, and it doesn't really have anything to do with, what you do as much as, when you do it. And so with a sideways market, that's almost as bad as a down market for a lot of people who are entering retirement because they're not recouping any value of what they're taking out for income. And I think that's one of the big fears. I don't have as much conversation with people about how much money can I make in retirement. It's always about preserving what they have. They want to keep what they have. They need their income, and I just don't want to lose my money. I've worked so hard for this. And in a sideways market, that sounds good if you're not taking anything out from it, if that's really your goal. But when you're retiring off of those funds, a sideways market is and can be tragedy for most people. So negative or flat is bad.
Well, not for you, though, because you are here with us, and you are going to get some answers to these questions that you've had out there. By the way, I want to thank you for being here with us today. Many places that you could be doing all sorts of stuff. And I love that we're portable with you. You don't have to be in one place. You can be checking us out on the radio. You also could be joining us via podcast. And if that's you, we appreciate you hitting the subscribe button. It helps us out. It gets Money on Tap on the radar for people. And with that, we've got Money on Tap gear that we'd love to send you. Just drop us a line at info@yourmoneyontap.com or pick up the phone. Gosh, how many of us do that anymore? I feel like maybe we should have a text line in there somewhere. But it's right now, we want to talk to you at 855-226-8551. And you'll get an opportunity to just get your questions answered with Ben and I. And if you're maybe getting deeper into some strategies, maybe just taking advantage of 1 hour free financial planning with us, we'd love to just at least get you the right information for your specific scenario and get you on your feet. And not just wondering, but having confidence, taking the steps you need towards financial freedom, that peace and security of mind, that you know where you're going and how to get there. Love doing, and that's just part of the planning process. If you've never gone through a planning process, that's an outcome that you can now understand where you're at and what you need to get under your belt to go where you want to go. With that, guess what? It's time for Money in the News. First up today, well, Mr. Google or Alphabet or whatever you want us to call you these days, rumored AI life coach could guide you through life's challenges. Thank you, Caesar Cadenas. The report is that Google claims it's testing an AI that can give you life advice. Well, what would this look like? The next big AI project, DeepMind, Google's own artificial intelligence research lab, has been testing technology that effectively turns generative AI into a personal life coach. This could be, hey, put together a diet for me, or a workout plan, or it could even get into, I'm not sure I really want to go to this friend's wedding or can't make this friend's wedding. How do I respond? What's interesting about this is that it goes against what Google's Bard, their suggestion board that they have basically on the interface of their Chrome. My understanding of that is, but this goes against the underwriting of what Google's policies are, that they will not supply anything in the realm of advice in this sector. Basically, it just crosses the line. I'm looking through here. I'm like, where is that information? It was right there. They've got their disclaimer that they're not going to do these types of things with their AI. Well, apparently the AI race has turned them on their heads, where they're willing to even take a look at this and reconsider what it could do. And there's part of me that says, hey, that would be wonderful to have a place to kind of go to backstop an idea if I'm not sure how to navigate a social scenario, or if I'm really looking for some tools to improve my health and all that kind of stuff. And the other part of me says, do I really feel comfortable with AI?
I know. I read this article. My brain is going the same place you are, Seth. I'm like, this is incredible. They state that DeepMind is trying to find a way to have their model, quote, perform at least 21 different types of personal and professional tasks. And then they get into like the whole holistic portion of caring for you just because of the competition of ChatGPT. And I'm thinking to myself, at what point in time does, the Google AI so tired of dealing with you, like, yeah, the only help is to jump off a bridge or something crazy? I mean,
what's the liability here?
Yeah.
If it just spits out something.
We did an article, I don't know, a month or two ago. I don't even know what it was. Remember, it was talking about AI and the different slants that people have from liberal to conservative. And I mean, when does someone getting personal professional help that this thing, recommends like a sex change or something crazy? When you emotionally connect with something, logic goes out the window a little bit. So I think you're right, Seth. Like when does liability, does it tell you to break up with your girlfriend? Does it tell you to change and quit your job? Like where does this life advice go? I mean, if you quit a perfectly good job, lose your house, and your family's, stranded, well, Google Bard told me to do it. I wouldn't go there.
Yeah. So maybe not essentially creating a robotherapist is not the edge that it needs. And I was thinking about this, like, when are we going to have, and it's coming because guess what? It popped into my head. I'm not the only one thinking these things out there. There's a, what would Jesus do? Chat GPT.
Go say you're sorry. Don't do this.
No longer do you need to spend time in the Word and have a relationship with the Holy Spirit or any of that stuff. It's just like go to the chat thing and just they'll tell you where to go and what to do.
Yeah, it's so true, right? Everything trying to remove God from your life. Next up, we have from The Hustle, from Sarah Friedman. The shroom boom is coming to the candy aisle. Now, this is kind of a funny article, too, but there's been, there's this huge awareness of some of the health benefits in the fungi family of mushrooms. Now, there's obviously, we're not talking about the ones that are inappropriate to use, but they do joke around about that. But they're actually covering these things with chocolate and created to be tasty. They have all sorts of great side effects that are really good for you, like reducing anxiety or helping with your brain chemistry and thinking. Is Japan and China, like, they've been using this stuff for years, and hey, they've got an idea here that sounds pretty interesting. That's they're going to make some money off of selling it as a treat. Shrooms are multifaceted. As the article goes on, the shrooms are multifaceted, and brands have been tapping them for more PG or appropriate purposes. Namely, they're taking over the sweet new sector of chocolate. Fun Girls is a chocolate bar. Alice, a wellness brand called Alice, sells tinned mushrooms, which are good for sleep and focus. And Vehicle Mushrooms makes coffee and chocolate bars. It's three great companies that are, kind of making a name for themselves, which I think is really interesting in the way they're trying to distribute.
Yeah, I became aware of it when I had gone through my cancer and surgery and was meeting with a nutritionist and really trying to figure out, hey, what's really good for my body and is going to help prevent cancer from ever coming back. And this was one of those things that was high on every list across the board of the potential of benefits that some of these mushrooms have. And, I, in my coffee, every morning I put this stuff called mud water in there, and I put it in with some MCT oil, and I blend that puppy up. And I got to tell you, I love my coffee in the morning. It's a whole other level. And then I also have a local farmer here too he grows lion's mane and shiitake and all these other mushrooms that are in here. And I just pick them up from him and into the salad or meatloaf or whatever else we got going on, it goes. So
I love the fact that people have, these amazing ideas, though, and they make really good money doing it. And there's wonderful businesses out there. So much work in endeavoring to find these companies. I'd be curious. This is an investable opportunity. I'd like to see where this comes out in the stock market at some point.
Okay. All right. Warren Buffett, second largest bet after Apple, is paying off, by Matt Krantz. Thank you very much, Matt, from Investors Business Daily. And by the way, that's a really great publication if you're not familiar with it out there. I'll put a plug in for them. So Warren Buffett's best known for his largest bet, a massive stake taken in Apple, but his second largest sector position, financials, is starting to pay off. And the ETFs they're saying an ETF is a way for you to join in. Maybe, maybe not. Okay. So what did we learn here? Well, for one, Warren Buffett owns a lot of Bank of America and a lot of American Express. Now, one of the things you may not know about Warren Buffett and American Express is he was buying it in the 90s. When did he first buy that? He bought it in 1991, $300 million in purchase there. And he stopped buying it in the late 90s, but it has continued to grow in a position for him as a result of stock buybacks. And it's phenomenal when you take a look at what has happened in that, how that's played out in Warren Buffett's positions. Not necessarily where you're going to go immediately if you're looking for the kind of returns and looking at those returns, thinking you can get that out of a Warren Buffett position. However, the sector itself has done really, really well. And Warren is certainly one of those places that we love to go to and see, how are you doing? How have you done what you've done? And what nuggets can we take away from this?
You can't be like Mike here. You can't be like Warren, right? You can't buy 300 million shares of American Express, 30 years ago. But
I would buy his shoes, though.
I would buy his shoes. So he's primarily focused in Bank of America and American Express as his 20% of his public holdings for Berkshire Hathaway, and that's really interesting. And one of the article swings, which I think is interesting, is to get financial sector exposure. They reference the XLF ETF, and I think what's interesting about that is 3-4 months ago, and this financial crisis with Silicon Valley Bank, we actually took an engagement in XLF. That was the ticker into one of our diversified portfolios. So there are opportunities in this space, but obviously when you're getting to an ETF, your exposure to the XLF, the financial is the F. When you're getting exposure to a lot of financial organizations. It could be 100, 150, 250 different stock exposures, where Warren's is very, very unique and very specific. It's Bank of America and American Express. When you have a lot of assets, you really can just jump in and buy the stocks, right? You can say, I really like this company in this sector, and I'm going to own that stock. But when you're really trying to create diversification and the volume of assets you have is not great enough to create really healthy diversification, you buy the XLF or you buy the ETF that gives you exposure to that industry. So you can get a gold ETF, you can get a financial ETF, you can get an industrial ETF. That gives you the ability to have that similar exposure, but you obviously have companies under there you may not value or appreciate or may not want to own, but you would end up having a portion of your assets allocated there. So I think that's one of the pieces where an ETF can be a detriment to somebody, but it also is a wonderful tool if you really want to get very intentional focus and a sector grab on a specific industry.
I love it. And that's what you got here at Money on Tap. We're going to take a quick break. Now, when we come back, we are going to be talking about what to do in a sideways market. How do you invest in a sideways market? Don't go anywhere. It's going to get deep, and we're going to get specific, and we're not going anywhere. So don't you go anywhere. We'll be right back here at Money on Tap.
Hello, everyone. This is Dan Mickelon of Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors are here to help. Our team of experts will provide you personalized advice tailored to your financial goals. Visit us at BrayshawFinancial.com today and schedule your free consultation. Brayshaw Financial, investing made easy.
We appreciate you listening to Money on Tap. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. We are going to be diving into strategies for sideways markets. And if this is a new topic to you, well, don't worry. We're going to get through it together. And really, it's sometimes it's interesting that the perspective that somebody has around the sideways market is like, oh, phew, we're taking a break. It's not going up, and the emotion isn't riding high on it going up, and it's not going down, and the sky isn't falling. And what's an interesting piece to that is that the underlying fundamentals of what is happening inside of a sideways market. I mean, what are we even talking about? What we're looking at is typically we're looking at indicators like, well, the S&P 500 index, or the Dow Jones, or the Russell. Anyways, we're looking at an index, and we're taking a look and seeing, well, what is the trend right now? Is the market going up? Is it going down? And as it goes back and forth and kind of ping pongs back and forth in between the people that think they're buying and the market's going up, or they're selling and the market's going down, it just kind of keeps going back and forth. And this can happen for quite a while until either, the data or the news or the AI or whatever the thing is out there that happens to capture the market's attention moves the market. And usually in between here and there, you're going to see things like, well, let's see, a false positive or a false negative. That's kind of what it looks like, where you'll see the market just jump and go crazy. And everybody thinks, oh, this is it. We're doing it. And they jump into these trades, and everybody falls into, thinking that the market's going one direction. And sure enough, you get just as much of a pullback of people saying that's not it. And they're selling the market. And, if you've ever been in a situation where this sounds familiar and you're kind of going back and forth and there's indecision and nobody seems to know how to figure this piece out, and we're going around and around, it can be very taxing and a little bit concerning if you are in the demographic that's trying to retire or stay retired through this period of up and down. And it can be just as catastrophic inside of this kind of an event for somebody that's in retirement trying to take income, because that's what it boils down to in retirement. It's about cash flow and income. And if you're relying on a market that's been going up to feed that income to you, which is, very common in how people want to try to get income out of their assets is, market goes up, they take a little bit off the table, goes up a little bit more, take a little bit off the table. But if you're doing that in a sideways market, guess what your portfolio is going to be doing, people? It is not going up. And yeah, you're taking it off the table, and your portfolio continues to go down. It is a diminishing event, and we're going to talk a little bit about that as well. Ultimately, what are we talking about? What are we angling for here with you? To have some takeaways and some food for thought and some pieces to add to your understanding of how you do not have to become a victim in any of it. You don't. You can be empowered to make decisions over your finances and your plan to move through these events and have success.
Seth, so much right there, and I really appreciate you saying all of those things. I think a lot of people don't realize that it's the historical returns, right? I mean, we all know that we have, the stock market started here and it ends there and it's up, and we're riding these waves while we're accumulating our assets for retirement. But these historical returns we keep referencing as, the stock market averaged 8 or 10 or 11 or 7 or whatever you did, right? Was over the last 20 years that you were invested in your 401k or your brokerage account or whatever you were doing. And now you're walking into this, you're going from that accumulation phase to the distribution, the income phase of retirement. And all of a sudden, all these ups and downs, swings, and just the market kind of bouncing right in between a certain threshold, that sideways market piece that people are talking about, or that negative market piece. It is extremely hard to create income and maintain wealth during those types of markets. It's just you're eating away at your principal slowly in a sideways market. And like you said, sideways market also have small ups and downs or big ups and downs. But when you get from the start to the finish, it's flat. And there's a lot of people out there that are concerned that we're looking at that over the next 3 to 5 years, that we have, between the election, between the interest rates, where the Fed's going, are they going to lower them? Are they going to continue raising them? There's so much uncertainty, and that's what's swinging the market, and no one knows what that really means. And so just like everyone else, there's as many bets down as there are up, and everyone's getting thrown all over the place. And I think what's really interesting about this is this forces people to make really good decisions on how to solve retirement income planning. And we're going to talk about some of those today, because if you have a negative market, we all know that's bad for retirement, right? If you have a sideways market, that's also bad for retirement. And so that requires solution-based planning as much as anything. So if you're in the camp of they all don't know what they're doing either, which I'm all in for the Fed. I think they're just trying to act like they know what they're doing at this point. And I know that's pretty low on the totem pole, but that's kind of where I feel they are with these interest rates. We've got some concerns. I mean, if this is a crash landing by the Fed on our economy, that's going from sideways to negative. And you need to solve retirement today before you find yourself with half your assets or another 2008 kind of event in the stock market. That you don't want that financial tragedy happening to you in a way that would just absolutely take the wind out of every sail you have. I think that's really where people are concerned. I would also preface this by saying, and we talked about this, and I would encourage people to go to our website, BrayshawFinancial.com, go over to the right. There's a place where this says client login. Just to the left of that says resources. Click on resources and go down, and there's some video options and so forth. And sequence of returns, I think that's the first video in that section, Seth, right? I think that's the top one. Click on that 2-minute video, watch it, because it will go through how you can do everything exactly the same as everybody else. And within only a couple of years difference, you can go from rags to riches and have done nothing different from one other person. And that has nothing to do with your ability to invest. It only has to do with the day and time in which you had put money in. And that's really a scary thing for a lot of people because we ride these markets. But in the distribution phase of retirement, that is the most treacherous time to take money out. And then they say if you don't have a positive market cycle for the first 5 years of retirement, you're most likely going to be running out of money. That's a scary conversation. And people don't want that. So we want to talk about how do you mitigate that in today's marketplace? And we have, 5 big conversations. They're not all the solutions out there, but we have 5 big conversations for you guys today to really talk about, does this or could this be a solution for you in solving retirement planning for you?
Well said. I think that's going to bring us actually into, the first of our solutions here for you today, which is the fixed income world. This is a space that we have over the last, I was actually, when you said 2008, I was like, well, how long ago was that? Because then I wanted to go back to 2000, right? And the tech bubble. And it's like, oh my gosh, we have gone through we've gone through a lot in our markets. And if you want to even go back further than that, there's 1987 and all these events that have taken place that are kind of these events that we take a look at historically and say, well, what could possibly happen if there is something that moves through that's systemic in our economy or in our financials. The reason I even bring that up is because over the last 10 years, the fixed income world, like a CD, right, a certificate of deposit, go to the bank, give in your money, and they give you a guaranteed return for 3 months, 6 months, however many years you buy the product for. That's one of those places that we're talking about. I mean, that is a very, very stable and guaranteed place. One of the very few places where you can say guaranteed, and have a return. And today that's a market that's available for you. We, over the last 10 years, since they lowered rates really to that floor that the Fed did, there was nothing available in this space for you. If you're looking for guaranteed return, we'll get there. There's other places where we had to go to get it, but today it is a place where you can create some stability inside of your cash flow, and that's the CD, and that's a bond as well. And inside of that fixed income or bond world, there are several different places that you can diversify. Diversification is one of those models that we look at. A lot of the time we talk about it inside of, the S&P 500 and equities and buying companies but there's all sorts of different asset classes, and there's all sorts of different ways to diversify. For instance, that diversification in the fixed income world could lead you into some preferred securities, a strategy that focuses on income in the utility sector, for instance. And then, you can have different ways of diversifying around that. Now that's kind of going down a little bit of a rabbit trail. We're going to shoot that rabbit right now and not go too far down that road. And just come back into this understanding that there are fixed income opportunities today. And this is one of those places where if you are in retirement, we want to try to drive, again, income through what are our opportunities.
Yeah, I would say, Seth, when we talk about number one in the CD space, this is kind of like back in the vision, right? This is something that is new to our current economy after many, many years of so super low interest rates that CDs were laughable. But now, you're looking at CDs from anywhere from 1 to 5 years in the 4.5% to 5% range. You're looking at a legitimate rate of return. I was looking at a couple of different various offers, and I'm looking at legitimate banks offering anywhere from 4.5% to 5%. Now, that's a phenomenal rate, right? So you put your money in, you walk back to the bank, and you have your money back in 1 to 5 years. The question is 5 years from now, what is the new rate, right? So that's one of the things about CDs or bank issues is that reinvestment risk what we call reinvestment risk comes to play, because you're actually wondering, hey, can I get that 5% again? I mean, that happened back in the 70s. Like, people were buying, CDs at like over 10, 15%. A lot of people listening probably even remember those. I didn't purchase those, but you couldn't get those again. And so there was a lot of like upheaval in people's rate of returns that had put their money there. And I think that's one of the things that people fail to remember, that, nothing is forever. And we usually go into investments thinking they are, like, well, I'll buy my CD now, and then 5 years from now, I'll buy another one, and then I'll buy another one. And I had a conversation with somebody the other day just about this, was that, hey, I know that's what you can make, but if you launch your income today off of something more stable or more guaranteed or more consistent from an investment perspective, we're going to talk about some of these things as we move on into the show, you don't have the reinvestment risk. Like, reinvestment risk is a really big deal. And I think, you could actually have reinvestment risk, you could be overlapping. You could buy a CD today at 5, find out that in 2 years you could get one at 6 or 7, but you're stuck in that one for 5. And then, by the time you actually, get your new CD in 5 years, it could be back down to 3. Rates continue to rise. That's going to be something else you have. So, mitigating that and kind of working your way through that is always an issue. And a lot of people, when it comes to CDs, it's self-management. And I think one of the other problems with CDs and this self-management is that you're laddering your CDs. You buy one for a year, you buy one for 2 years, you buy one for 3 years, and you buy one for 5 years. And you're constantly cycling these CDs and constantly dealing with reinvestment risk. And guess all the work you have to do? Oh, I got to find this bank, and I got to open an account there and do this because that bank is offering, a 0.1% more than my bank. And then you're evaluating those things. So reinvestment risk and the work behind it can be a lot. Now, I would also preface this with another warning, buyer beware, that when banks are offering a CD rate that's too good to be true, well, it may be insured if you stay within the insurance limits of, $250,000 a person, but also understand that banks who are short on their deposits will offer better than normal interest rates to get more deposits to meet their overnight loan rate issues so that they can reduce their expenses. They'll offer you a little bit more of a premium in what they pay you. But, if that bank goes under, you have to go then deal with all the paperwork and the claim work with the FDIC. Like, you're going to have to go get your money. So that's not going to necessarily be a fun process either. So the highest CD rate, though, insured, and if you're in the insurance limits, is great, but understand that as the Fed has dealt with, the Silicon Valley Bank crashing, you don't want to have to worry about having to deal with a long, claim process in that scenario.
So we've talked about CDs, and we've just brushed up a little bit on bonds. We're going to actually circle back on some more of this bond some of this bond income. And, there are some pitfalls. There's some advantages. There's some pitfalls. So don't go anywhere. We'll be right back. We're going to get into some of that with you here at Money on Tap. We're going to take a quick break. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Thank you for the subscribes. Make sure to drop us a little note. Let us know that you're there. We want to send you out some Money on Tap gear. Thanks for being here with us today. Don't go anywhere. We'll be right back. More on strategies to invest in a sideways market.
Are you looking for personalized guidance to kickstart your investing journey? Look no further. Brayshaw Financial Group and our planners are here to help. Our team of experts will provide personalized advice tailored to your financial goals. Visit BrayshawFinancial.com today to schedule your free consultation. Brayshaw Financial, investing made easy.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Thank you again for the subscriptions. Joining us out there in the podcast world, we want to make sure that you get some Money on Tap gear. Drop us a line. We'll send you out your Money on Tap swag. With that, we're going to jump right back into, yes, how do you invest in a sideways market?
You know, Seth, as we jump into, and I know you chatted about bonds and I know you talked about preferred stocks too, and there's just so many different solutions out there. So we're not covering them all, but we're trying to cover these basic ones and give you some perspective on some alternatives that you can do to enhance this. But the bond market's really interesting, and that has also been kind of reemerged since, you know, the whole Fed raising rates. So now bonds have become a conversation or a story again as an investment. And in a sideways market, buying a bond is great because you can buy a bond and physically own a bond, collect its income, and then hold the bond to its maturity as long as it doesn't have a callable feature, meaning that the person who you lent the money to can't say, hey, I'm going to pay this thing off. So you can look at that stuff to kind of mitigate that reinvestment risk we talked about before. And I think that's really exciting. And a lot of people say this is great, especially in today's marketplace, because I don't want to take a lot of risk. Just want to preserve my assets and I need income. So bonds have become kind of that, you know, back in the front, view of retirement. But if you are laddering bonds, you know, that can also involve reinvestment risk. So you got to kind of be prepared for that, because usually there's a ladder involved somewhere, meaning you buy one for 1 year, 3 years, 5 years, 10 years, 20 years, or whatever. So you constantly have cash coming available if you need liquidity. You know, Seth, you know, we've done a lot of work around the tax-free bond space and working through that. But, you know, one of the things that really helps people mitigate maybe not the high returns of the stock market is trying to get more tax-free income by using those municipal bond opportunities. But a lot of people aren't aware that not all muni bonds are AMT exempt, meaning alternative minimum tax exempt. So if you're in a higher net worth bracket, you really need to make sure that you understand which type of, you know, tax-free bond that you're buying so that you can place that into your solution. But if you can do that and get a decent return, the tax incentive opportunity may ripple through your entire investment system and your tax code to me a meaningfully larger return theoretically than, you know, just buying a bond and letting it fly through the tax code. Because, you know, depending on the state you live in, your current income, maybe you're working as a consultant, like there could be 5 other things that say, I shouldn't own this bond or I shouldn't own bonds at all. And I think that's really an important buyer beware conversation that we should have, you know, or have with you as a listener, so that you make sure you're not just putting all your money in bonds or CDs and understand these risks.
Yeah. So things to be aware of in that muni bond world are the funds that go towards stadiums, airports, or, you know, things that are considered more business-like enterprises. Those are kind of red flags for us out there as we're taking a look at what do you have in your portfolio and how's that, you know, interacting with your taxes. Because you could be looking at, you know, 26% or more on these AMT that the bonds that are not AMT exempt, basically. What does that look like? Maybe a bond paying 3.5% to drop to roughly 2.6%. So that's pretty significant when we're trying to understand what we're getting out of what we're putting in. Next up, we're going to look into, you know what? I love this space. I love this space. I just look at it, look at the word, and I'm like, oh, heaven, goodness, value. Value. It's
something new for us, Seth. Something new for us, a value stock.
Yeah, these are not your Goodwill stocks. No, these are more of like your LL Bean, right? That's the way you want to think of it. It's the LL Bean in this world of like, why are we in this thing? Well, it's because it works, right? It works. And speaking of what works, you know, one of the places in value that we talked about earlier in the show, or could be value, is the financial sector. You know, for instance, this is not a recommendation, but just take, for instance, like a Citigroup. All right. Heard of it. Big, right? It's big. It is paying a dividend, roughly, 4.3%. Okay. That's great. Now, that financial sector could go up and down. Right now, it's been favorable. All right. But what we're looking at in that is that they are fixing some of their infrastructure and their technology on their platform, which is, an elevated short-term cost, right? But as those costs decline, you could be looking at a very profitable stock. But it's a space that you need to, get paid to wait, basically.
Yeah, I mean, I think the thing about value is, right, the stock's not guaranteed, the dividend's not guaranteed. There's just nothing guaranteed about it, right? It's a stock. It's the highest risk investment you can make. But I really do like the blue chip kind of stock conversation quite a bit, because as long as you're willing just to own the stock and ride it, just like Warren Buffett's been laughing about some of the stocks he bought that he's, the dividend was low, but now it's like equivalent to a 40% dividend or some crazy number from his initial investment equivalent. It's very interesting. And I just think that if you can find a company that has a really secure dividend, or you feel it's secure, you feel like it's a good quality company, I think it's kind of own the stock, ride the market, keep the dividend. That could be a portion of your play. And I don't think any one of these is your all-in solution. I don't think CDs, bonds, or stocks are going to be your all-in solution. But, if you think we're in a sideways market, there is value, can do pretty well in a sideways market, which is kind of funny. So knowing what you own, collecting the dividend, if that's going to solve your problem and you can diversify your risk well enough, I think there's a real potential play for somebody who understands this kind of risk. And we've been doing this for years. I mean, I really like buying value stocks, kind of selling them into a positive market, and then looking for stocks that are kind of oversold and really kind of trying to cycle that as much as we can. But I mean, some value stocks you can just buy and hold almost forever based on all their history. So that I would never recommend, but I would tell you that there's some statistical analysis around that that people can really look at, that it's like trading the stock doesn't make any sense. I think we did an article a year ago or 6 months ago about Johnson & Johnson that it was better to own the stock than trying to trade its highs and lows. You actually lost out on dividends and everything else. And the math was it was cheaper and better just to own the stock and carry it forever. Now, that was the historical analysis of that. Now, whether that continues to carry on, I have no idea. But trying to be a trader usually doesn't work out for the average Joe.
Yeah. When you take a look at sideways markets, and there's initially a belief that maybe I can actively trade that market, which is what Ben was talking about. And, most of the time people, even in that, like, for instance, the Johnson & Johnson scenario, are not going to be successful in doing that. I think of my grandfather, who was he was a John Deere employee, and he got John Deere stock, but he was what they called a channel trader. But he knew exactly when, within the... Oh,
he's doing insider trading, Seth? Was he doing it?
Within the month or the week, something like along those lines, when John Deere was going to go up and when it was going to go down, because it was tied so significantly to the agricultural cycles, right? So that's a cyclical kind of a trade. And in a channel trade, which is, trying to hit the top and then hit the bottom and then hit the top, as it kind of ping-pongs back and forth, it's so hard to know if you're there or not. And unless you're in that trade daily and you're actually using some, pretty good tools, which we could cover a few of those if you want, how to do that and be engaged in those trades, your likelihood is you're not going to fix this. You're not going to solve this. And for the most part, somebody that's in retirement, we find, is not looking for this as a solve to trade in and out of the market. Really? That's what you want to do to solve your retirement income, when there's, frankly, far better places that we can go. Speaking of, is it time for some structured products?
Yeah.
A little bit of that dual direction stuff that we're talking about that kind of solves it for you?
Yeah, I think, one of the things about, structured products and what goes on in that space is, interesting. There's a lot of different options. Structured products really are designed for people who want to buy things to protect a little bit of the downside. And there's lots of options and hedging around it, and they try to, provide you the opportunity for the upside. There's, that has been used a lot for people who are saying, if I can just cut out the bottom loss and kind of start over every year again, that might be an interesting opportunity for me. But a lot of the structured products aren't income geared. So, this is a great scenario for somebody who says, hey, I want a 10% protection on the downside, but I'm not really sure what the market's going to do on the upside. But if we have a 15% loss, at least I would have the first 10% of that loss protected. Now, these are complicated products, and I wouldn't say that they're for everybody. They need to sit down with somebody, find out if it fits. But again, this is all about sequence of returns because, again, a sideways market or a negative market, you have to make up that return plus make up the income you took out each year, right? I mean, that's really the goal. So you have to outperform losses in the market. Structured products at least take off the table, in my opinion, a portion of the market loss. And most of the time, if you buy a structured product that's 10, 15, or 20% buffered, meaning that 10, 15, 20% loss in the market would be replaced essentially or recovered by the option trading that's around there, then you're at least made whole on the market loss, right? But if it's significantly lower than that, you can still tumble deeply. Like if you have a 10% buffer and the market goes down 40%, like 08, well, hey, you just lost 30% of your money. That's not recoverable. And that's just as bad as, the full exposure. How do you mitigate this stuff? How do you address this stuff, Seth? This is where, really our fifth scenario for you is going to cover a bunch of pieces. I think all of these could play as your option, but I think number 5 can be a nice icing on the cake.
Sounds tasty to me. I hope that's carrot cake. We're going to take a quick break and we'll be back with more Money on Tap. Number 5 coming up. You don't want to go anywhere. You don't want to miss this. We'll be right back. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Hey guys, Seth Cressman with Brayshaw Financial Group. Are you ready to take control of your financial future? Look no further than Brayshaw Financial Group. Our team of experienced advisors is dedicated to helping beginners like you build wealth through smart investing strategies. Visit BrayshawFinancial.com today and start your journey towards financial independence. Brayshaw Financial Group, your partner in wealth creation.
We appreciate you listening to Money on Tap. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We have been talking about investing in a sideways market or strategies for investing in a sideways market. And we're at number 5 for you. Guess what? It's time for the A word. Annuity. Yes, ding, ding, ding. You got that right. An annuity, a guarantee to pay, an investment insurance. Boy, I'm start that over. It's an investment inside of or an insurance vehicle that has all sorts of different flavors. It can start off as a immediate annuity and a guarantee to pay at for 10 years at X amount of dollars per month or per quarter, giving you a guarantee of such, XYZ percent. And that's the other place, people, that we come back to that G word, guarantee, when talking about opportunities to invest. And it's an interesting place for us because as fiduciaries, as financial planners, we're not just wealth managers. We're not just managing the market out here, investing in the stocks and bonds and portfolios. We are taking a look at the whole person, and we're solving for retirement income, taxes, all of it together for you. And this is one of the places it gets missed so often, or it gets, drummed on so hard that people just don't know what else am I supposed to do? The only thing I can do possibly to retire is an annuity. And that's just not the case for most people. It's a part of a plan for you that if it makes sense, if the tool works and it accomplishes your goals, it can do a lot.
Yeah, I think the word annuity is like, for a lot of people, it's kind of like, hey, that's a big word for me. There's a lot of information. I'm not sure what to do. The word annuity, like Seth said, means guarantee to pay. So some insurance company is going to guarantee you something, but they shove all sorts of investments underneath it. Even structured products we were talking about earlier, they shove those into annuities, and then annuities have income features to them. And those become pretty interesting. One of the big issues that people have about annuities is they're high in fees. Well, matter of fact, there's a ton of annuities. I don't know if I can say most, but there's a ton of annuities out there that have no fees. So understand there are some that do have high fees and some that have no fees. And so you have to kind of work your way through that space. And I think it's really interesting because you can't cancel anything out. And in a sideways market, an annuity drives a significant amount of power, a significant amount of opportunity in a sideways market, like almost like nothing else. Because in the annuities with the dual direction kind of space, meaning they make money when the market's up or down. That's crazy to say, right? The market went down, you made money. There's portions of downside opportunities, I say opportunities, downside losses in the market that can create upside returns for you. It's just the way they work. So complicated, yes. Something you need to sit down with a professional, yes. Something you should just run into, no. But there are those options. There's also the word annuity is just creating an income stream, irrelevant of a structured product or any other feature or facet. What I would say is, and I was working with somebody the other day, and they said, "Hey, I need," they're in like late 60s, I think, and they needed income, and they needed a couple grand a month. And I think we talked to them. They had talked to another person about a variable annuity, and they would have to put almost $500,000 in that variable annuity to get $2,000 a month or $24,000 a year. We granted, that's a lot of money. Granted, that's a guaranteed income from that annuity company, and that is a market-based investment. But then we talked to them about a fixed annuity that would provide them $24,000 a year too. It was a spend-down strategy, and it also had a long-term care feature to it. There was a lot of stuff going on with this thing. But we told them, hey, listen, it's highly likely that there's not going to be any money left over in this annuity in 20-plus years. You're probably going to spend this one down. But in a sideways market, this is guaranteed for you and your wife's life. And guess what? It's like $300,000 you need to put in. Like a $200,000 difference. And I said to them, what's great about this is now that creates your lifetime income need. And then that $200,000, well, that's totally investable. So let's say this isn't a sideways market, and in 20 years from now, we're past the sideways piece and whatever. That $200,000, I mean, that could literally be at 7% in 20 years. That could literally be almost $800,000. We could have recouped all of his money and then some, but he could have had the flexibility of that $200,000 liquid. And I think what people don't realize is that sometimes just creating that pension for you and your wife, or your wife and your husband, whatever, like you're both sitting down, you're trying to figure this thing out, and you say, well, how do we take all our money, stick it in a CD or stick it in bonds and create income from that whole massive asset, right? So, hey, I could take $500,000 and stick it into a CD paying 5%, and great, for the next few years, I'm going to get $25,000 a year. Or I could take $300,000 and stick it into an annuity possibly and get the same income per year. And I'd have $200,000 still on the sidelines to do everything else I want to do, or just invest it. And what people don't realize is using these investments in connection with each other is really a lost art in our industry. And I think that's what makes us different, is that because we're three-dimensional investors and we work in all of these domains with regularity, that a lot of people only work in one or two of them, makes us different to allow them to work together for your strength in your portfolio.
Yeah. You guys have got some really great information in front of you today. The next step, right? We talk about that at Brayshaw Financial. Your next step. It's up to you. It's up to you. You can give us a call at 855-226-8551. Reach out at info@yourmoneyontap.com. No matter what, get the plan in place. Get disciplined around that. have some certainty in where it is that you're going and what you're doing, and allow yourself that freedom. Give that gift to yourself to have that freedom, so that this is time that you can invest not only in wherever those tools are in your plan, but also invest in what's most important. You, your relationships, your giving, whatever God has called you to. Be successful in your investing. Cannot wait to be here with you next week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.